Hello, my name is John Wells, a partner with Morris & Wells Wealth Management. Today, we are here to discuss some basics between four different asset classes: stocks, bonds, certificates of deposits known as CDs, and money market accounts. And as usual, nothing said in this video should be considered a solicitation to buy or sell securities. So let's start with stocks. With stocks, the main thing to know is we are, as stockholders, we are getting paid to accept a certain level of volatility, meaning share prices going up and down. And because of that volatility, over the long term, historically, you've been paid more to be a stockholder than in most other asset classes. Risks are complete loss of your principal, and benefits are the appreciation is really unbounded. It depends on how well the company performs at an operational level. Also, final note on stocks, it is a minority interest. It represents, in most cases, a minority interest in a business. And I think sometimes we think of them just as stocks as just paper, pieces of paper, or bits on our computer screen. But it does represent an underlying minority interest in a business, and as such, you, as a holder, are the owner of a partial owner of the corporation, and over time, corporations will try to improve their operations and grow their earnings, and hopefully stocks appreciate accordingly. The second asset class I'd like to cover is bonds. And those can be government bonds or corporate bonds. There are varying kinds, and generally speaking, if you buy a bond, you get a stated rate of return and you receive your money back when that bond matures. Something that could jeopardize that is if the underlying company goes bankrupt, then you may not recognize the value of your initial investment, or you're forced for circumstances unforeseen to sell the bond, and the bond price will fluctuate during your holding period until the maturity date. Therefore, if you needed the money and interest rates have gone up, then the value of the bond when you go to sell it may have decreased. Likewise, if interest rates have gone down, the value of the bond may have increased. So, generally speaking, a defined rate of return, and you should get your money back when the bond matures. The next investment option would be CDs. Generally, you would purchase a CD from a bank or a credit union. You're generally guaranteed the return of your principal, and because of that guarantee, you receive a lower rate of return than you would otherwise expect over the long term in stocks, for example. And with CDs, there's generally a penalty if you need to take the money out before the maturity date. So that some people could view that as a negative. And then the other investment sort of asset class would be money market funds, and money market funds can be purchased through brokerage account. Our clients are in custody at Charles Schwab, so we use a number of Schwab money market accounts, and money market funds are supposed to keep the net asset value and pay a given rate of return based on the underlying investment instruments within the money market fund. So they are supposed to be safe. Their principal is not supposed to fluctuate, and there's no penalty for buying in and out of those funds like there is in a CD. So those are the four general asset classes that we use at Morris & Wells to manage your assets. The other asset class would be cash. The benefit of cash is it's very liquid. You could move money in and out of your account. It is in cash on any given day. However, cash is paying no rate of return presently at our custodian. So there are really 5 asset classes that we would use to manage your money. And if you are interested in a further discussion about that, please look us up at morrisandwells.com or our social media sites, the Instagram page and YouTube channel, as well as you could just give us a call at 434-977-7010. We'd love to chat more. Thank you.